Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we're solving the chapter 18 quiz from the ACCA Study Hub. So let's get started. Alright, this is question number 1 over here. Who are noise traders? Investors who prefer to invest in companies that look likely to make stable but low profits. So if you have watched the revision lectures, if it is a SOAR definition that has been given, stable but low profits for loss aversion. So this is not noise trading. Then investors who do not make investments on the basis of rational analysis. This is exactly the definition that we have studied for noise traders. Then part C talks about investors who lack the confidence to make their own judgment and hence follow the investment strategies of others. So again, this is the very definition of herd trading. Then option D is investors who have a tendency to seek information that reinforces their opinions. This is the very exact definition of confirmation bias. Hence, option B is your answer. All right. So let's move to the second question. The following data relate to an unquoted company. Unquoted basically means a company which is not listed on the stock exchange. So the dividend which has just been paid out is $180,000. Payout ratio is 40%. Return on investment is 15%. And the cost of equity is 20%. So you have to find out over here the theoretical total market value of the company's equity. So according to the information that is available, it is clear that we are going to use the Gordon's growth model to calculate the growth rate, and then we will calculate the value of the equity. All right. So let us first calculate the growth rate according to the Gordon's model, which is equals to BR. So let us first find out RB and then R. So if you see R basically is essentially given to you, 15% is the return on your investments. Now we need B, which is the retention ratio. So if 40% they are paying out, that means what they are retaining is 100% minus 40%, which gives you 60%. So how do you find out your G? Your G is nothing but equals to 60% multiplied by 15%. So this is your growth rate that you have worked out. Now you have the dividends, you have the growth rate, you have the cost of equity. It's pretty simple to calculate the market value. So how do you calculate the market value of equity? We use the formula that P0 is equal to D1 divided by RE minus G. So this is the formula that I will be using over here. Dividend which has just been paid is 180,000. This has to be, let me use brackets to separate numerator and denominator. 180,000 is the dividend of this year, and this has to be multiplied with 1 plus the growth rate. So 1 plus the growth rate, which is 9%. So this is my numerator. And for my denominator, I have the required rate of return, which is the cost of equity, which is 20%, minus your growth rate, which is again 9%. So I close these brackets, and with this, I have the market value of the company's equity, and this is option D over here. Moving ahead, what does a high price earnings ratio indicate to the investor? So basically, you have to tell that if the price earning ratio of a company is high, what does that indicate? So basically, if you see the numerator is price, which is the market price, and your denominator over here is your EPS. So if PE ratio is high, that means numerator is high, that means the market price is high and the earnings are lesser. So what happens over here? Basically the market price represents what is the price that the investors are willing to pay to buy that share. So the people are ready to pay a higher price compared to how much the company is earning. So obviously people will be ready to pay a higher price only if they think that the earnings have growth potential. That is why option A is your answer over here. Moving to question number 4, Quinton Company's most recent statement of profit or loss is as follows. They have profit before tax, taxation, net income. All right. Net assets in the statement of financial position were 4.5 million. What is the value of what is the annual dividend growth rate computed using the Gordon's growth model? So over here, you have to use the Gordon's growth model to calculate the growth rate. So let us do so. So this is the formula right in front of us, G equals BR. So first I need the B as well as the R. So R, if you see, is nothing but the rate of return. So to calculate the rate of return, I am going to take my net income, which is 400,000, and I'm going to divide it by 4,500. So this gives you your rate of return. Now I need my retention ratio. Out of a profit of 400, I am retaining only 100. So 1 by 4 becomes my retention ratio. Now my growth rate is nothing but a product of both of these values over here. So this gives you 2.22%, which is option D over here. So question number 4, option D is what we choose. All right. Now, question number 5 says the Trump company has 7% convertible loan notes in issue, which are redeemable in 4 years' time at their nominal value of 100 per loan note. Alternatively, each loan note could be converted after 4 years into 50 ordinary shares with a nominal value of $1 each. Now, the current share price is also given to you, and the expected growth rate is provided as well. And we also have the before tax cost of debt. So we all know that to find out the current market value, we are going to use the NPV of all of the cash flows, which is discounted at the rate of the investor's required rate of return, which is nothing but the before tax cost of debt. So let us perform the calculations. In year 1, I'm going to get an interest of 7. 7% of 100 gives you 7. Year 2 also you get 7 interest. Year 3 also you get 7. Year 4 also you get 7 plus the higher of conversion or the redemption value. So option number 1 is to take the redemption value, which is taking $100. Option number 2 over here is you get these shares, get converted, like the debt is converted into equity. How do you do that? The share price is $2 per share, and it is expected to grow 7% every year. So first I need to find out how much the share price will be. So after 4 years, the share is probably going to be worth 1.07 raised to the power of 4, because this is a growth rate which is applicable for 4 years. Now this is the price that is going to be there for each share. Now for this loan note that I have, I am going to get 50 ordinary shares. So I can just multiply this by 50. So this is the amount of money that I will have the option of. Always and always the rational investor is going to choose the higher one. Obviously, if I tell you, will you prefer to get 100 rupees or will you prefer to get 131? You're going to choose the higher value. So with the same logic, in the last year, I get 7 as the interest plus the conversion value, which is 131. So these are all of the cash flows that are going to arise for the investor as far as this loan note is concerned. So the rate that we use is going to be your before tax cost of debt, which is given to be 10%. So 10% and select all of your values. Hit enter and then you have your answer. Option A over here is your answer. With this, we are through with the chapter 18 quiz. These were pretty simple questions. I hope that this video helped you to clarify whatever was unclear. Thank you so much for watching.